Hey there, welcome to our office hour today. And I am your presenter. My name is Lunta Di La Paulo, and I'm excited to be here with you tonight. And I'm going to be talking to you tonight on a subject of negotiating and deal structure if you are looking to acquire a firm. Okay. So I'm going to share my screen here with you just to help you get a sense of what we're going to be covering tonight. Okay. So key negotiation tips and deal structure for marketing agencies. So if you are in the process of acquiring a marketing agency, a small business, okay, I want to share with you some tips tonight that will help you get a better deal for you and your investors if you have any. Okay, so let's kick things off with what we're going to be covering today. This is going to be one of the shortest live that I'll be doing because I actually have to run for my flight in a little bit here. Okay. Okay, so just a quick overview. We're going to be looking into general deal structure elements, and then we're going to look into the idea of BATNA, and then we're going to wrap up with best practices. Okay, so we're going to be here for about 20 minutes or so, and we're going to be covering these topics. Okay, so let's kick things off with general deal structure elements. Okay, so the first thing about deal structure, if you're looking to buy a business, is how do you pay for the deal, right? How do you finance the acquisition? You have approximately three or more elements that you can put together to finance a potential business acquisition, right? When you write your LOI or your IOI to the seller, right, they need to know a little bit how you intend to finance the acquisition, right? And typically it's a good idea to have a call with the seller and to walk them through what they will be seeing on an LOI. Okay. So if you are planning to use debt elements or a mix of equity or some additional sweeteners, right? You want to include these as part of your conversations with the seller before you actually write an LOI or IOI to the seller. So, so the first thing that you need to be mindful of is if you intend to use that, you need to stress that your deal before you can determine whether or not that would be a good option for you, right? If a given company is not generating enough cash flow in its current state, it probably would not be a good idea to put that into that company if they can't even meet their own operating or capex requirements. Unless you have a deal that is cash flow positive and it has enough buffer to cover that burden, right? You can think about that. And the way we think about structuring that, typically we look into senior debt and junior debt, right? The senior debt are probably going to be your commercial debt from a bank or an SBA backed loan. Okay. Typically today in the US, with SBA loans, you can borrow up to $5 million to acquire a business at relatively favorable terms today. And these debts are typically going to be collateral, will have some form of collateral from the business. Okay. They're going to be what we often consider secured type of loans. Junior loans are not necessarily collateralized. They don't have an asset securing or backing these type of loans, and therefore they require slightly higher interest rate for the borrower. Okay, so when you are thinking about a mix of debt that you can use, it's important to stress that to stress that stress test, excuse me, your financial model to make sure that it accommodates the different type of debts you intend to use. Another important element here that I'd like to add that I didn't include in this slide is working capital, right? When you buy a firm, it usually doesn't include cash in the bank account. So you need to come up with cash. And when you buy a business, typically, banks don't lend you the money for working capital after the acquisition. So it's a little bit challenging to get really good terms when you buy a business and you try to generate quick liquidity. So a good best practice is usually to include some form of line of credit provision to support your working capital needs, right? So usually what I see and I've seen done with clients or when I participated in deals, we're gonna see an acquisition loan plus a line of credit for working capital. Okay. So these together will make up the debt portion. But I also need to add here before I move to equity element, right? Excuse me, under the junior debt, right, we can also see what is considered seller financing, okay, a seller note. Usually, seller notes are subordinate, meaning they come under the bank's loans. Okay. So the seller notes are going to be coming in situations where, if you can find a seller who is looking to exit as soon as possible, in that situation, right? Very often in the small business arena, you find sellers willing to provide financing. So very important. Right now, what I'm seeing in the market, you can get, depending on the industry, you can get seller financing between 20% to even 80% of the financing. There are situations where you don't even need to involve a bank to finance a business acquisition. You can simply work with the seller to come up with some form of seller financing arrangement, right? And you more likely also get favorable terms there. Okay. So that's one thing that I wanted to add here. Outside of the debt elements, they are equity elements that are integrated, right? So if you're gonna be coming up with a piece of equity from your own savings, from your own capital, right? So that needs to be added. If you are not going to be coming up with cash out of your own pocket, you need to raise money from other people, right? Whether it's investors or partners, right? And I need to make a distinction here. Partners are not necessarily always investors, okay? Because if you raise money from partners, according to the US laws, right? There are certain rules that you have to follow for security laws if you raise money for investors, right? So you'd need to work with attorney to file certain documents with the SECs or state agencies or use one of the exemptions to raise money from investors. So it's very important to be compliant with security laws so that you are not in trouble, right? So you also need to understand if you're raising money, right? Make sure you know what you're giving to the folks you're raising money from. Are they gonna have voting rights or non-voting rights? Are they going to be silent partners or passive investors or passive partners who are going to be active? Okay. So very important to keep that into account because when you include that on from your LOI that we're going to be financing the acquisition using a debt portion and our own equity, right? The excuse me, the seller may not know where your equity injections might be coming from, right? But the bank is gonna need to know where your equity injection is coming from. One of the deals that I helped last year, towards the end of last year, we had a situation where the buyer, excuse me, actually used a portion of the seller's note as an equity into the deal. So that's also one of the possibility into how you structure a deal. But all of these needs to be part of the conversation with the seller. Okay. So you can't just write, an LOI that the seller, that doesn't spring from a previous or early conversation with the seller. Okay. So that's very important to keep in mind. The third element here that I want to add here into our conversation is around sweeteners, right? I consider them sweeteners. Other people might consider them as other, provisions in your LOI, right? So one of these is usually earnouts, right? The idea around earnouts is if the business hits or meets certain revenue or profit level, right? Because the seller is making some representations, is telling us this is how the business has done, and we say okay, we believe you, but we just want to make sure we're protecting our interests as well, right? We're going to be paying you to exit, but we want to make sure that what you're telling us, it's going to be what we expect to see in the future. So if revenue doesn't hit, let's say the seller said the last 3 years the business generated $1 million per year, then we're gonna say, hey, a certain percentage, we're gonna pay, let's say, X amount of money if the business generates $1 million next year after we take over. If it doesn't, we're gonna reduce dollar by dollar to whatever remaining balance we have to pay. Excuse me. Okay. So that's kind of the idea around certain contingency elements, right? So an adjustment to the price of the business, right? Or to the seller note if the business doesn't actually meet the expectation that that the seller made as a representation. There are other contingencies, other ways to structure a deal. But the most important elements, you need to decide whether or not you need to include some debt elements there, some equity elements there, or if you plan to, pay full on cash, if you want to use certain percentage of debt and so forth. And having a professional to help you articulate and navigate and run these into projections to see which deal structure would yield the most optimal return on your investment, it's always a good idea. Okay. The next item we want to look at is the best alternative to a negotiated agreement, right? When you are coming to the table to negotiate with the seller, you have to have, you know, a place where you'd say where, at what point is this deal could become a bad deal for us, right? What element are we comfortable conceding, giving away? And what element we absolutely need to see before we can decide to move forward to close this deal, right? So whether it's, the debt structure, the debt makes the minimum cash requirement, or certain, folks that you need to see staying in the business, or certain clients contract to be signed before, the closing date, and so forth, transfer of leases, things like that. So it's really important for you as a business owner to have your BATNA. Okay. If you're looking to acquire a business, right, just by having your BATNA, it helps you know, okay, when it's the time for me to walk away, and when do we still have enough room to continue the conversation into exploring the possibility of getting this deal done? Okay. I've seen transactions where, both parties, the buyer and the seller, decided to walk away to later come back in and compromise a little bit, and if you give me this, I can manage to give you that. Okay, so something like that. So because both parties essentially have their own BATNA and they see the value in getting into this transaction. So as long as none of the party is gonna breach that level of BATNA, then it's possible to continue the conversation. Okay. So once you have that done, right? And as I said, you need to know, at what level the deal, a good deal could become a bad deal. Like what could happen or what would be necessary for this deal to go, from a good to a bad deal. Okay. So very important for you to consider. And then the last item here that I want to touch on quickly is what are some best practices in negotiating. Of course, this is not exhaustive and it doesn't even cover 50% of what I could have shared with you based on my experience with my clients, assisting them, acquiring and selling businesses. Okay. So number one, you really should not forget your BATNA. Okay. Because the moment you forget your BATNA, you're probably starting to enter at the dangerous territory. Okay. A place where a good deal could become a bad deal really fast. So as a business owner, it's on your best interest to remember what's my BATNA. Okay. And make sure your attorney, your accountant, whoever is involved in your negotiation to also remember what's our BATNA. Okay. So that's number one. Number two, make sure to not compromise to the point where your bargaining position deteriorates significantly. What do I mean by that? So remember the idea that I shared a few minutes ago around how a good deal could become a bad deal. Okay. So when you are giving things in exchange from things that the seller is giving you, you want to make sure that it's of equal value or approximately similar value. Okay. Because if you don't do that, what's going to happen is you're going to end up in a situation where you're getting less value than what you're giving. And there's a consequence. Your position may actually be in a losing territory. Okay. So just be aware of that. And the third item is not to ignore the red flags. Don't ignore the red flags. Okay. And when I say red flags, when you're negotiating with the seller and the seller's team, pay attention to their tone of voice, right? What matters to them is going to come out from how they speak, from how they carry themselves, their body language, essentially, right? See how they are talking among themselves in their team, right? See how their voice fluctuates when they talk about different items in the deal structure, okay, or in the overall contract, right? So I'm gonna give you an example. I was working on a deal that the seller and the seller's wife would always tell the buyer that, hey, we just want the best for you, you know, but we don't want to sell to you something that it's going to be bad to you. If you think this is not good for you, please tell us, and it's okay. Okay. So they repeated that so often that literally I had to pause a little bit with the buyer to talk to them. Hey, are you seeing a pattern here? Is there anything that we should have known about this business that they're not telling us? And that's maybe why they keep telling you that they just want the best for you, the best for you. But also they keep, you know, rushing you to close the deal, right? And I told them, hey, look, if you're gonna move forward with the deal, at least by looking into the number, everything seems to check out, and I don't see any problem with the numbers. But I don't feel comfortable with how quick they want us to close the deal, and in particular, how they keep telling you that they just want you what's best for you, and they don't want to sell you something that is not gonna be good for you. Okay. I just want you to keep that in mind as you navigate this. But the decision is yours. If you decide to buy this firm, it's your decision. If you decide not to buy it, it's also your decision. And he ended up not buying the firm because he just realized that the process was going too fast, and even though the number looked okay, we really didn't have enough time to dig into every possible thing, right? And some of the sellers expectations were highly unreasonable, right? The seller didn't even want the buyer to write an employment contract for them. Like they wanted to hand the buyer an employment contract, right? So things like that, you really want to be a little bit skeptical and be mindful about, how the dynamics in a relationship looks like, and what you should move forward on or not move forward. Okay. But the last point, which is one of the big element here that I want you to take away, is the danger of escalating commitment, right? The idea of escalation of commitment is when people are so committed, right? We already spent money on this. Let's just continue, and maybe eventually it's gonna work out, right? And they continue just pouring money, more effort. Hey, we started this due diligence. We already spent a lot of money. The bank already approved the loan. Let's just close the deal. And even though we're seeing problem, we're gonna fix it. Probably not a good idea. Probably not a good idea. Okay. So we really need to be objective when we are negotiating, when we are approaching the seller and their team, and especially with our own team as well, because sometimes I'm an attorney, excuse me, I'm a CPA. Sometimes our CPA or an attorney would entirely derail the deal because they are so focused on one particular aspect of the transaction, and they don't see the big picture that you might be seeing. So it's very important for you as a business owner to be mindful and just keep the balance, keep everything floating in the direction that, excuse me, that you want things to move. Okay. So it's about 23 minutes. I'm gonna need to run. uh, if you have any questions or if you need help with anything, please feel free to reach out. Here's my contact information. You can reach out to me through my email address, luntadilapaulo@luntadilapaulo.cpa.com, or through my phone number. I'm also available to help you if you need help and you are going under uh, due diligence, you're looking to acquire a business or selling your business. Okay. We're here to help you to get the most optimal result for you and your family. Have a great rest of the day, and God bless you. I'll talk to you soon.